Hi there, I'm James Strode, publisher of the Global Legal Insights to Fund Finance, and joining me today is Sabih Hussain, Head of Global Fund Finance at Barings, and Sam Hutchinson, Partner and Co-Head of Fund Finance at the law firm Cadwalader, and of course a contributing editor to this year's Pink Book. Thank you both for joining. Good to see you.
Good to see you too, James. Thanks for having us on.
Great. Thanks, James. Thanks for having me too.
Let's dive straight in, and I'll start with Sam. 2023 is firmly in the rearview mirror now, some would say thankfully, because last year was a slower year in terms of fundraising. But predictions and early indications suggest that those levels will increase in 2024. However, a big question comes around liquidity. So Sam, from your perspective, I'm keen just to hear a little bit more about where you see that liquidity coming from and in what kind of structures to mitigate this potential issue.
I think if there's one word, at least for me, that sums up where the focus of the market has been for the past probably 24 months now, I think it is liquidity. It's one of the big questions and challenges that I think we and the market generally has been trying to solve for, whilst fundraising levels have been subdued. And I think the reality is that the subdued levels of fundraising have almost muted the issue. But I think once that activity level picks up and normalizes, I think we're going to see the true extent of the supply-demand imbalance, particularly in respect of subscription facilities, which I think has been masked while those levels have been down. And the big question is that where is that liquidity going to come from, as you say, James? I think that the reason, well, lots of reasons why we're concerned about liquidity levels for supplies in particular. I think various factors include, lenders are very closely looking at the impact of Basel IV, which will come into effect during the course of next year, and the impact on the capital that they'll need to set aside for these transactions, which will become significantly more under the new regulations. I think lenders have been very focused on product loan book caps, wanting to make sure that is being provided to core clients, and not necessarily having the capacity to look outside of that. I think many lenders are being pushed to demonstrate a wider business case for these facilities, including ancillary facilities. And I think throughout the last 24 months, a lot of market players, including ourselves, have been trying to find a solution for this. And I think various banks and outfits have gone a long way to try to develop structures which will better suit institutional money coming into our space. But it's definitely challenging. I think the obvious investors on the institutional side of these deals are insurance companies. And if you try and marry what they need from an investment perspective with our deals, it is difficult, right? Because undrawn committed RCFs are not attractive for insurance companies. Banks holding undrawn positions creates a drag on their returns, and Basel IV is only going to increase and deteriorate that overall return profile. Typically, investors need longer notice periods, and typically the distribution structures that we have worked on to date have been very complex, and they've taken a lot of time. There are only really a few banks and other outfits that have got a lot of experience in devising these structures. So I think we haven't found the absolute perfect solution as yet, but it's certainly something that a lot of us are very focused on.
Fantastic, thanks, Sam. And Sabih, just thinking about your perspective and pain points within the industry at this moment in time, what do you think are the biggest pain points that lenders can solve for GPs to add value to their clients beyond, well, just an injection of debt?
Yeah, so James, it kind of relates a lot back to what Sam was touching on. I mean, the debt is important, right? So somebody in my role, so that's absolutely key. But outside of that is actually coming up with different solutions. Some of the things that Sam touched upon, such as, Basel IV, and is going to require lenders to actually get sublines rated, for example. The NAV product has come back in because it's kind of got that hybrid element, which actually works better for the balance sheets. And also providing ABLs at a lower concentration limit as well. And with all of that in mind, it's coming up with good ideas, listening to the GPs and what they need and what they're trying to solve, and actually being a cross solutions provider across the lending platform. I think sometimes some lenders are set up to do that, some aren't. So you get 5 different calls from different parts of the bank trying to almost sell you the same sort of product almost. So I think if lenders can sort of look to the future, look forward, and see where the trends are internally and within the market, and actually, package that together for the GPs, I think that's going to be a great solution. One idea that some lenders are very good at and some aren't is that, such as the FX services they provide alongside the facilities, sometimes they're packaged, sometimes they're not, and those are one of the things where I think if they haven't got that right, they're going to struggle to get the package of services right too.
It's great. So thanks, Sabih. But both of you have mentioned innovations, solutions, and so forth, and that's something the industry have been coming up with for the past numerous years. Constant evolution, increased market participations, but there are still those macroeconomic issues and issues around exits being harder to achieve, and obviously we've mentioned fundraising being a bit slower. Sam, how do you see the current market dynamics impacting this era of fund finance over the next 12 months?
I think you hit the nail on the head there, James, in terms of, I think, what is great about our industry, which is that we try to be as proactive as possible. So the distribution structures that I mentioned previously, that was something that we've been working on now probably since about 2021. What we try to do, is, to Sabih's point, is actually think about what the GPs will need and are thinking about as far in advance as possible. And it's one of the things I love about our industry, and certainly, the Pink Book this year, I think, is the substance of it. The topics covered are better than I've ever seen before. So just a little thank you for putting that together, James. I think it's excellent content this year. I think you're absolutely right that, hopefully 2024 will be better than 2023, but equally there are definitely going to be some, consistent challenges there. I think one of the themes, at least in the early part of this year, is going to continue to be a very challenging exit environment where traditional exit options are pretty limited. And I think there are, to my mind at least, there are probably 2 ways in which we can, working with GPs, continue to find solutions to those things. They're not necessarily new products, but just applying the products and the thinking that we've already done around the products in the market to these, I guess, different use of products. So I think the first is, the continuing use of continuation vehicles and the popularity of those, which makes absolute sense. But I think the shift around continuation funds is actually they're being used for very, very good assets, as opposed to assets which perhaps are the last in the portfolio to be sold. And what that does is, by moving the very good asset into a continuation vehicle, getting an additional injection of capital means you create almost a perfect structure for hybrids, which are often talked about but hardly ever done to be used. Because if you blend the new capital with the robust underlying investment, you've actually got on a blended basis a very attractive proposition from a credit underwrite perspective. There are obviously differences with a typical subline and NAV facility, but together, to my mind, they create a really interesting dynamic for lenders who are able to get comfortable with the underwrite on both the investor side and on the asset side, with a good returning product there. I think the other thing I'd be remiss not to mention NAV facilities, because they're in the press, it seems, every single other day at the moment, if not more frequently than that. And I think certainly a lot of it is negative. We, Cadwalader, sort of issued what we hope is a more balanced article around the use of NAV facilities in the latter part of last year. And I think, NAV as a product is not new. I mean, certainly more buyout managers have been using it recently, which I think is the reason why it's sort of attracted a lot of press attention. But it's not a new product. And I think that, you know, what we're absolutely not saying is it's suitable for every single portfolio, but it can be an extremely useful tool that very few other products can actually provide. And what we're really hoping is that the dialogue is important, right? It's important to be discussing these types of facilities. And we're going through, I would think of it as a growing up phase insofar as NAV is concerned. Bear in mind, we had exactly the same issue with sublines 5-6 years ago, where there was a lot of, you know, discussion around those. But I think NAV facilities in the current environment can be very, very useful for managers in terms of creation of liquidity, in terms of underlying assets or follow-on investments that need additional liquidity, where other debt products or equity products don't quite achieve the same results. So I think there'll absolutely be more discussion around those during the course of this year. I definitely expect an uptick in volume around that in response to, you know, the continued challenging exit environment.
Sam, positive reflections there. Sabih, can you offer any other positive notes for 2024, not only perhaps just from a product side of things, but looking at it geographically? Are there any other areas, perhaps the Asia market, that you see ripe for growth this year?
Yes. So, James, I'm going to pick on something that Sam touched upon as well regarding that positive note. Hopefully, I can turn this into a positive note for everybody. One of the key things that has been the slowdown in the fundraise period is down to the actual recycling of those portfolios. And that's why that continuation product has really come into flavor now at the moment. Some of the products that we see in the US that are very good for continuation products are mid-market CLOs. So that is a product that's been talked about a lot in Europe, as we have some of these older vintages within the European market, for example, that we're trying to find an exit for those vehicles and an exit for those investors. They're performing portfolios, and as Sab said, they're still diversified, still strong, and there is a market for this. It's just that we haven't had those products traditionally in the European market. So I think that 2024 could be the year we do see a private mid-market CLO in the market issued, and that would be great. The fact that the BSL market in Europe hasn't been strong, that hasn't been the traditional route for most GPs such as ourselves, but you know, there's always hope that will come around. Also, something from a, you know, what we're seeing is the tenors are increasing on deals. From the pandemic period of the 1-to-1 deals, we're now seeing, you know, 2 years and 3 years out there as well. That's not probably great news for Sam's business, because those refis do generally raise a lot of consistent income. But it also makes the focus back to the GPs and the teams to actually go back and focus on origination and what they're really meant to be doing on these deals as well. In comments to APAC, I had the benefit of being a global person sitting in London, outside of the traditional US financial hubs. And we are seeing a lot more interest in Asia as well. So this year we're launching 2 APAC products. And, you know, they've been on the cards for a while, but they're actually coming to fruition. We are actually mandating lenders in that space. One thing that Asia is dominated by and has that benefit is that they have a very strong grouping of sovereign wealth funds, which will actually use products such as ABL leverage facilities and not just the traditional cap call lines. And so that market's not going to evolve the way the European market, which is sort of a few years behind the US market. I think that's going to have its own evolution on its own.
Thank you, Sabih. You've touched upon really nicely APAC. You can see and read more insights in the Pink Book on APAC and things that Sam has touched upon, from NAV to hybrids and CLOs. There's a lot more in the Pink Book as well for further reading as well. So thank you both for joining. Much appreciated. Some fantastic insights. As I say, from here, would invite anyone who's watching this to take a look online at the Pink Book this year with all those new insights. Of course, you can pick up a copy in Miami at the Fund Finance Association's Global Symposium in a couple of weeks' times now and throughout the year. So thank you both for joining again, and hope to see you in Miami soon.
Definitely. Thanks, James.
Thanks, James. See you there.